So let's turn our attention to sort of macroeconomics. And I don't personally think that macroeconomics is investing. I think it's speculation. And how you define speculation and investing are two very different things. But one way to think about it, the idea of risk parity is that you rebalance as the returns are coming in, and you assume that returns are linked to risk, but I don't think they necessarily are. So anyway, let's go ahead in the discussion to kind of what is speculation and what is investing, and a lot of this is semantics. Speculation, you can define it as the attempt to profit on the price change of a security or of an instrument. Let's just be very vague here, of an instrument which has no discernible fair value. So in other words, you cannot determine the fair value of some security. And a lot of the securities we're going to be talking about today, you actually cannot, in my opinion at least, really determine their actual fair value. I love, for some reason, I find it therapeutic to actually sit here and erase it like this as opposed to the. So things like the euro US dollar pair, there's no actual discernible fair value. You can't sit there and do a lot of calculations and a lot of diligence and say, I think this should be 130. It's more of a gut feel, and it's sort of like you're relying on different principles that are really speculative, in my opinion. There's certainly, and we'll talk about what those principles are, but I don't think they're discernible. So in any event, that's sort of what I think speculation is, whereas what I think investing is to profit on the price change of an instrument which has a reasonably falsifiable, discernible fair value. You can sort of falsifiable, meaning you can scientifically determine its fair value without using sort of the voodoo, which I think is a little bit more voodoo methods of sort of guesswork that you see in macro speculation, which again, I'm not here to insult them or debase them or whatever. I think that it's just your taste. I like the sort of scientific method of value investing. Some people like the speculative kind of psychological perception, and we'll talk about that in a minute. These are kind of what weigh in on this, whereas this is sort of calculating, diligencing. And it's all up to you. And you can argue that these two are a branch of the general concept of arbitrage. The idea is that you can determine the future price of something while the markets can't. Whether you're going to do that through investing or speculation, that's the idea. And we've spent a lot of time on how to do that in investing. How to calculate something and say, I think that's a good investment because I think I'm going to get paid higher than my discount rate, etc. Whereas in speculation, you're sort of doing the same, but it's through a little bit of different methodology. But either way, you're trying to make money, which is sort of what arbitrage is. You think that, say, euro dollars at $1.10 and it should be $1.30, and you're going to make that 20% by speculating. Whereas investing is sort of the same. You see a common stock for $10, you think it's worth $50. You're going to arbitrage by making an investment that's calculating and diligent. All right, so what kind of things that we have to look at in macro? Maybe we should start by discussing the actual instruments that you can trade, and then we'll work our way backwards and talk about what it is that you're going to look at when you're trading those things. So in general, when people talk about macro, they spend a lot of time talking about currency, or sometimes we call it FX, foreign exchange. So currency and foreign exchange is a very sort of simple, simple thing. People speculate on the value of currencies. Here's the British pound. You can see this dramatic drop after Brexit. The pound is conventionally quoted in the number of pound. Let's see. It's actually here. It's the price of £1 in dollars. So you can see that it took $1.50 to buy £1, and that dropped dramatically. In other words, the dollar strengthened to the point where it's now $1.33, and you can see that the currency hasn't recovered from Brexit. It was a huge drop. If you look at the historical return histogram, 1 sigma is 1%. So the idea that this currency dropped quite a bit more, about 10%. That was a 10-sigma event, which is really telling. A 10-sigma event should never happen. If you know anything about statistics, a 10-sigma event should actually never, ever happen, right? But it wasn't temporary. You can see the pound drop was permanent. I don't know what looks temporary. Temporary would be what happened to the Swiss franc. The Swiss franc had a huge temporary drop here or move here on the Swiss bank saying they won't peg, and it actually went right back. So a lot of people went out of business on the Swiss franc situation. So currencies are basic currency pairs, where you have one currency against the value of another currency. And you can do this in baskets as well. You can say, well, I'm going to bet the US dollar will appreciate or depreciate against a basket of currencies. You call it the broker and say, I'm going to look at emerging market currencies like the Thai baht or, I don't know, several currencies like that. You could pick any currency. There's some currencies that are barely tradable. Last year I was trying to put on a big trade for the Kazakhstan. This is a currency that doesn't trade easily, but we were trying to capture this move. Basically, this is a weakening. Kazakhstan's a huge country. You can see the price of $1 in Kazakhstan, so in the Kazakhstan tenge. We expected this to blow out, but there's no way to actually trade this. So we were hoping that we could. This is why one of my traders named Lewis, I wouldn't call him a trader, but one of my employees called Lewis, and I encouraged him to spend some time, 90% of his time focused on pharmaceuticals, but 5 or 10% of his time he could spend looking at anything. And we looked at the Kazakhstan stock markets and currencies, and this was a lot of fun. What happened is there was this huge, basically the entire country is focused on oil. And what we were trying to do is figure out how to exploit that. Oil is, if you looked at oil prices have been dropping for many, many years. I think this is superimposable. And this country has its entire economy based on this commodity. And eventually this peg would get blown apart, and you could actually double your money unlevered, right? So you can make 10, 20, 50, 100 times your money on this trade. And that sure beats trying to figure out if Pfizer is worth $20 or $30, making 100 times your money. But the problem is this volatility. I don't know that you could have gotten this leverage. Now, pre this trade, you could see it wasn't very volatile. But with each peg move, you could see that maybe it was a little volatile. But here, you can see that with this scope, you could sort of see, sorry, I'm not doing this very well, but you could sort of see that, it's a little fritzy here. You can see that the axes were just very, very unimportant. But then you could see that if you change the axes, these moves are, you just change the date scope, these moves are enormous. This will probably blow out to $500, but there's no real good way to trade it. So we actually thought about ways to start an import-export company and hold some kind of carry trade. Anyway, currencies are a huge part of the macro investors or speculators kind of toolkit. So what else do these traders trade, and why? How do we predict currency movements? We'll talk about that in a minute. It's not just things like that. This is a really weird currency. This is not a currency anyone trades. So how do we look at currencies that people actually trade? We'll do that in a minute. I'll give you a hint. Currency and inflation tend to have a direct relationship due to what we call the carry trade. So the carry trade is this idea that if you have deposits in a country, let's say you have deposits in a high inflation country like Brazil. Well, the thing about having those deposits is they're going to be in the safest places. So let's say like Brazilian government bonds. If you have money in a Brazilian bank, they're not going to be in a bank like JP Morgan. They're going to be in a Brazilian bank in Brazilian bonds. And here you can see that these Brazilian bonds are yielding 2.7%, which is a very healthy yield. A similar bond in the United States yields quite a bit less. And if you went to some other area, let's say like Russia, some Russian bonds, you're talking about really big yields. I don't know, let's pick, so 3% comparatively against a treasury bond is quite a bit higher yield. If we look at, let's see, what is that, 6 years from now, right? So we pick a treasury that's 6 years from now, you're talking about a 1% versus a 3% in Russia. So rubles are a carry trade. If you have rubles, you might get the benefit of that inflation. And what's interesting, if we pick a time where the US had high inflation, and it did, and we pick a currency that existed, the euro did not exist when this happened. But if we go back to the 70s, not 2070, Bloomberg, but 1970, you can actually see this is the exchange rate of the dollar and the pound. You can see this weakening and this tremendous strengthening, unheard of in decades, where the United States, and let's go pick government bond and go back to the 70s. And you can see that this carry trade dominated, that you had this really high inflation, 10-12% inflation in the United States. And you also had this huge weakening or strengthening of the US dollar and a weakening of a very comparable currency, the British pound. And the reason, again, is if you had deposits in a US financial institution, just having that deposit would earn you 15%. So you'll run to the US dollar. Now, comparatively, you'd also have this tremendous inflation. So, it's an interesting dynamic, and you can see that treasuries have gone up. The yield has gone down in treasuries. So what else do people trade? Well, futures are very common. And you might say, if you're trading equity futures, are you trading equities? What kind of? So the equity futures are in the United States are called EMINIs. I don't know if this is the September EMINI or what, but these are futures contracts that you trade, and they're actually more liquid. Equities and EMINIs are different. EMINIs are futures. They're futures contracts. You can see here that they're actual contracts. So you have to deliver $110,000, and you can see the conversion ratios and things like that. Margin requirements are very low for EMINIs. Contract price is $50 per point in the index. So this is something that a macro fund would trade, whereas an equities fund might trade S&P ETF, which is the SPY. You need a special license to trade futures. Futures are one trade that you could put on, for instance, is you can trade the Japanese futures, the Nikkei futures. Here's a Nikkei futures. And what you might want to do is you go long the future and you can short the currency. And this could be a hedge, or this could be so-called Texas hedge, where you expect to make money on both. And so you can do all kinds of exotic relationships based on your economic ideas. For instance, you might say, well, what will happen is the Japanese government will ease. And this is the example of a macro trade. You would say short JPY and go long Nikkei. And why would you do this? Well, you might say, I think the government, the Japanese government, will ease more than expected, which will hurt the Japanese yen because of obvious, carry trade type implications. So I want to short the yen over, say, the euro or the US dollar. I'm going to go long the Nikkei because I think this will stimulate Japanese economic activity. Companies that form the Nikkei index, like Toyota or Sony, etc., will benefit from that easing of monetary policy. So this is a trade where you're hoping to make money on both. Currencies and their stock prices are not necessary, and sovereign indices are not necessarily correlated, but this is this sort of hypothesis that you do based on economic research. Say you think that economic activity is bad and therefore the government wants to ease instead of tighten. this is the only way to manifest this kind of trade. You can't do it in stocks. You can buy individual stocks, I suppose, but what are you going to do with respect to this trade? And these get even more complicated, and we'll see how and why. But that's sort of an example of some currency trades and some futures trades. Now, there are more than just equity futures. There are things like commodity futures. Commodities, things like oil and gold. And you might say, well, here's an example of a pair trade when we make it a little bit more hedged. So let's say I would want to have more of a hedged pair trade. I want to go long commodities, and I want to be especially in commodities that have gotten beaten up, like crude. I don't know about gold, but maybe I want to be long crude, and maybe some other ones, small basket of, say, gold and silver and some ag commodities. And I want to also be long equities. And this is interesting. This is sort of a hedged trade, and we can get even more complicated and say what kind of equities and why, and term structure and derivatives and all this stuff. But in general, why is this a hedged trade? Well, in general, these two are going to go in opposites. Things like gold and oil appreciate when equities go down. So this is a hedge that could make sense. You could make money on both sides, but in general, you're probably expecting to lose money. If equities keep going up, commodities will probably go down and continue to go down. But you might think that oil's had enough, and you think that you could do well on both sides of that trade. But let's keep going with the rest of macro. Suffice it to say, you can speculate on commodities and how and why you do that. I mean, sometimes there are alternatives to fiat, like gold is an alternative to fiat. And you can see, I don't know, I guess we can probably do some correlation. All right, so we can see that they're slightly negatively correlated, which makes sense. Gold drops when things are good, and gold rises when things are not so good. And we can edit this matrix and put bonds and all kinds of things in here, but in general, that's sort of the way some of those commodities work when they're alternative to fiat currency. Gold, people rush to gold for safety, but then there's actual utilities like crude oil is something that sort of is more actually the opposite. It's more correlated with economic activity. This is this crude? This isn't crude, I don't think. Let's see, crude. This is $45 a barrel, and there's some. It's not just about economic activity, but it is specific to the currency, like production levels and things like that. Right now, we've been a big crude bear market, but countries like China are going to be consuming even more crude, or will they? We don't know. China could be in a recession. They're not very transparent about where exactly they're at. And things like wheat and corn are a lot less liquid markets that are really complex. And you can see the huge drops in commodity prices for agricultural commodities like wheat and coffee and corn, and you can sort of think those through if you'd like. But they're sort of there's weather futures. There we go. Thanks for adding. But let's move on from futures and currency to some really interesting things, which is basically the entire sort of credit and debt markets, and those are really complicated. But you can go to something as simple as a trade like this is maybe the most popular trade in the world, and it's a bigger market than the stock market, which is the U.S. Treasury market. People trade the U.S. Treasury market every day. It's a much bigger market than the U.S. market, the U.S. equity markets in terms of trading activity. Debt markets are enormous, and you can see here that the yield, which is inverse to the price, jumps around quite a bit, and in general, it's been dropping pretty dramatically. We saw this chart earlier, but you can see that U.S. government bonds have gone up quite a bit. Part of the reason is not just the U.S. dominance in the world, but also the lack of inflation or deflation. We see a similar trend with the Japanese government bonds, or the so-called JGBs. When we look up JGBs, there's no good way to do this. They're generic JGB. I thought there was. Look at this. Yeah, you can see the JGB yields are also similarly low, and this is just part of deflation. Does tech cause deflation? What is it, monetary policy? Is it economic growth? What exactly is happening? We're not so sure. A lot of theories on it. I think it's more to do with technology personally than anything else. But that's the Japanese government bond long-term yield. So whether or not these things are good or bad is up to you. As a trader, you're just simply trying to take advantage of it. Now, these are the 10-year bonds. Now, I'd mentioned that there are 2-year bonds and 10-year bonds and 30-year bonds, and the difference between these is called the yield curve. And you can actually look at these yield curves. You can do it by hand, you can do it with programs like this, and you can actually, forget dollar swaps, let's actually just look at government bonds. Let's pick the US, and let's look at treasuries. So here's the Treasury curve, I-25, and let's actually look at it on a separate date. And look at that, a year ago, you could see that this, in the white here, this is really interesting. In the white, you have the year ago Treasury curve. And in the orange, you have this year's Treasury curve. And you can simply bet on whether or not this curve will flatten or steepen. And you can see that the flattener trade was better. The 10-year yield has dropped, and the 2-year yield has gone up a little bit. And the 1-year yield has gone up a little bit. You can make a $1 billion bet, or a $10 billion bet, or a $50 billion bet on flattening and steepening. And your counterparty would be probably someone like Goldman Sachs, who would set the trade up for you. But if you steepened and you had a flattener on, you would lose money. And if you flattened while you had your flattener on, you would make money. And this is so-called tens versus twos, where you can make it, by the way, any number you want. Goldman Sachs is happy to structure your trade and make a commission, or you can use Morgan Stanley or UBS or anyone you want. But the whole idea is that people trade these curves based on things like inflation and so forth. Bonds in the short end of the curve, you can imagine, have no default risk. Whereas bonds at the end of the curve, say 30 years, well, gee, I don't know if Hillary Clinton becomes president, and then, I don't know, Bernie Sanders becomes president after, and he's 95 years old, and he makes us a socialist country. Well, those 30-year bonds could be pretty risky. Whereas even if Hillary Clinton becomes president, 1 year from now, I don't know that, or Donald Trump for that matter, 1 year from now, I don't know that you could do enough damage to the country. So those are really just basically a proxy for inflation. Whereas the 30-year bonds become more of a proxy for default risk. So how those things move, again, you can see that they've flattened quite a bit. That means that the yield's gone down, so the price has gone up. If I were a trader today, I would put on a steepener trade, where I think the government disarray, you can see by our presidential candidates and our budget and things like that, the inflation's not going to change in the near term, but in the long run, I would imagine bonds will blow out. Now, a lot of people have lost a lot of money doing this trade. In fact, let's take a look at 5 years ago. Let's see what that looks like. Yeah, there you go. It's even more steep. So all it's done is flatten, 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 to the point where we're at this orange line, and it's really flat. I mean, it should cost you much more to borrow money 30-year obligation versus a 5-year obligation. But that difference, that spread, is flattened, flattened, flattened. And the reason is, paradoxically, I mean, we're assuming that there is no default risk in the US, and I think that will change. And again, there's a lot more to this. I'm not an expert in this stuff. I'm pretending I am, but I'm just merely kind of showing you what a macro hedge fund does. Now, there's things like LIBOR and swaps that trade on LIBOR, floating rate versus fixed rate swaps. I actually pasted this thing from ICAP, which you can actually look at, and then also this academic study. And again, if you're having trouble finding this, there's a link in the description box, and I'll post it again. So there's all kinds of things you could do with respect to the yield curve, or you can make direct interest rate bets. Again, the LIBOR and the Eurodollar are floating and fixed rates that you can trade around. There's options on these swaps. These are all generally called swaps. And the debt markets are fascinating. The other part of the debt markets include things like CDS. You probably know CDS as debt insurance. So let's pick U.S. government CDS to look at. Well, the U.S. CDS is very, very low priced. It costs 26 basis points to protect an entire portfolio of U.S. government bonds. There's almost no risk of default. Now, if the presidential election goes in Trump's favor, I bet these will bounce up quite a bit. But if you take a look at Brazilian CDS, Brazil is in a country that's in terrible straits right now. They keep firing their president and so forth. And for a while, there was some fear that Brazil could go bankrupt. And you can see that the CDS jumped up to 500 points. Now it's down to 256, but that's sort of like a 2% chance of default, which is really kind of interesting. Now, if you look at Greece CDS, they basically already defaulted, right? But it's 10 percentage points. So you have to give up 10% to insure your bonds there. Now, there's also CDS on companies. So you can look at like trade Amgen CDS. Amgen is very unlikely to default. You can see it's actually less likely to default than a company, mind you. And a company can do anything wrong. In fact, default just means you miss one interest payment. One interest payment. Amgen could have a drug that kills somebody or something like that. They could raise prices like buffoons. Who knows what they might do? But regardless, the cost of insuring Amgen bonds is extremely low. And you can have some fun with this if you actually look at the yield on Amgen bonds. There's no free lunch. So take a look at Amgen bonds. Let's pick, I don't know, some bonds like here. Let's see what they're yielding. You can see that they're yielding 2%. So if you insured these bonds, they'd be yielding 1.5%. You can see they're 70 bips above treasuries. So maybe you can have, in a perfect world, 20 basis points of so-called free money. The problem is they're not that liquid, and as you tried to put these trades on, your arbitrage would vanish. But there are sometimes, in real big panics, you can actually lock in some of these arbitrages, believe it or not. CDS are notoriously not transparent. All right, so there's all kinds of alphabet soup here, like CDO-CLO, which are collateralized debt and loan obligations. There's mortgage-backed securities, asset-backed securities. There's catastrophe bonds. There's all kinds of cool stuff that you can trade as a macro trader in practice. And there's exotic trades that I haven't even talked about, like weather and other really crazy stuff. You can make custom rates, like instead of LIBOR, you can have all these nutty kind of interest rates. There's volatility, we haven't discussed trading volatility, which is its own kind of nightmare. And you can basically trade anything you want if you find a counterparty. There's total return swaps, there's that are equity based, there's all kinds of swaps. So in any event, the instruments that you can trade are up to your imagination. In practice, most people are just trading futures and currencies and some yield curve stuff. But in principle, you could trade virtually whatever you want. And again, I think that if you're trading equities, if that's your poison, so to speak, picking your poison of what you're going to trade, and you've never heard of any of these things, well, how do you know that the largest arbitrage opportunities are in equities and not in something else, and like the Kazakhstan tenge or whatever it might be? And I think that's the sort of fallacy that we all have, this sort of universe fallacy, where we think that all the arbitrage is in whatever we happen to be looking at the time, which is obviously ridiculous when there are an infinite number of different kind of instruments to trade. But inflation is one of the biggest things we're going to be looking at in trading macro instruments. All of these things, some of them are literally directly instruments that trade off of inflation, like TIPS, for instance. But some of these are a little less clear, like currencies are obviously very tied to inflation, but they're tied to other things too. And certainly fixed income and any fixed income is going to be tied to it. But things like commodities, maybe they're not as clearly tied to inflation. Obviously, inflation is sort of the change of prices of various baskets of goods, and we have things like PCE and CPI and PPI that the government gives out, but I don't think they're terribly useful to us. We can obviously look at sovereign bond prices of countries with no default risk, like the U.S., and we can think about those tips as what inflation should be. But again, what is it? What good is it to someone thinking about inflation of something like a milk, carton of milk or whatever, rents? Those are important maybe, but if you're if you're a big investor that doesn't care about those things, you really care about your true purchasing power, in other words, your alternative rate of return in investments. Well, that's a more interesting concept. Maybe PCE and CPI actually don't matter at all. Maybe it's completely irrelevant. Maybe it's not. You have to think about that. But in general, inflation is a really important concept, even for equity investors, because it's ties discount rates to a reality. The reality is that over time, your purchasing power should drop, hypothetically at least. Again, whether that's practically true is a totally different question. You buying depends on what's inflating and at what rate, right? Buying a carton of milk, and we can see now that food markets are very different from what we thought they might be, and that they permanently inflate. Without government subsidies, it looks like food markets are actually dropping, which is remarkable. The price of a carton of eggs has dropped dramatically over the years. Look at even something as silly I hate to say it, as something like a illegal drug. The prices of marijuana and cocaine have dropped dramatically. So where is their inflation? I just showed you that equity prices, which is, you might not think of it as inflation, but one of my mentors, a guy named Ed, actually who's very, very good at hypothesizing things, maybe not as good as actually executing on them, but he said, well, equities and bonds are the biggest goods there are, and they have their own inflation, right? So we have to think about these things really carefully, and they're very, very psychological, and you just have to sort of think about them. No, the price of wheat has dropped about 95% over the last several decades. It's really remarkable. But again, I leave it to you to do that research. I don't do that research. So yeah, asset classes and their long-term prices, you can sort of go study that, look at it for gold, for instance. But things like water prices have gone up. So different markets have different pricing, and it's hard to look at basket prices and really think of them as relevant. All right, so what about things like GDP? Well, these are important. You can argue that GDP is a measure of inflation, depending on how you look at it. You could be really scientific and argue that the transactions in a closed system the number of transactions shouldn't change. But again, we're getting very technical and hypothetical here. You can measure GDP. You can try to measure it at least. The calculus of how we do that is imperfect, to say the least. And it's a very short-term transactional concept. So you can actually have the complete destruction of economy while GDP rises. And if you're maybe a Luddite, you could argue that technology will change the way we think about measuring things like GDP. So again, you can take the basic measurements of GDP and feel reasonable about them, but I personally don't. Again, a per capita adjustment is extremely important. Different revisions are extremely important. There's other economic data that we gotta look at. Employment is one of the best ways to measure economic activity, and again, all things like currencies and debt and things like that will change based on employment. All right, so employment is a good indicator of economic health. It's a labor market, but again, there's changes to that given technology. So none of this is monolithic. We have to be intelligent when we think about them. It's the same way we have to be intelligent when someone tells us stocks go up in the long run. Well, I'm not going to take your word for it, Mr. Bogle. Vanguard, for instance, believes this. Instead, I'm going to do my own homework. And the same thing applies in employment. We have to think about, well, is a huge unemployment in the face of increasing efficiency coming from technology? What does that trade-off look like? And we have to think about that really carefully. And I suggest reading the primary research from Bureau of Labor Statistics and things like that. Credit. I'm not going to go through this in great detail, but Federal Reserve controls the money supply, but that's sort of the main bank. There are shadow banks and things like that play a part of this. Money supply is controlled by all kinds of parties you wouldn't normally think of, but in general, the Federal Reserve tries to control money supply with things like QE, TARP, the federal funds rate, and so forth. You can think about money supply in many different ways. There are the M measurements and so forth. And then finally, you can just look at yields for a view of the health of credit markets. And sometimes yields are not exactly the same as credit activity, right? You can have high yields, but if there's no credit activity, it's so-called frozen credit markets. So we have to think carefully about that. All right, there's some macro hedge funds. Why would you invest? Why would you be a macro hedge fund? Well, one big advantage is liquidity. There's a lot of liquidity in these markets. You can trade $1 billion or $10 billion of a currency and nobody will care. Whereas if you try to trade $1 billion of an equity, people will go crazy and then report about it. But if you buy $1 billion of yen, no one will even blink an eyelid. There's a lot of people who are talented. So if you have a good natural gift for trading, this is a great place to embody that gift. Most people don't have that natural gift, but if you do, there are some people who are truly talented, like Soros or so forth, Druckenmiller, that are just get it, and they somehow have unlocked in their mind all of these relationships. But in general, I tend to not believe that those people exist in at least in more than just a handful of them. The disadvantages are that everyone has the same ideas in these markets. Everyone's in the same trade, so to speak, because there's only so many instruments to trade. So who are some of these hedge funds? Bridgewater, Soros, Moore, Caxton, Tudor, etc. Some of these people are so good at it that it gets beyond a educated guess. There's p-values that suggest that it's impossible to have the trading record of some of these traders. Now, having said that, arguably with enough attempts, you would have someone who's an outlier, but in general, it's not possible. There are individuals, by the way. There's some people like Joe Lewis, who I encourage you to look up if you're interested. So sometimes you make so much money that it can just be your own money.